Okay, go on to the next question, which is P129. Recording business combination. Flynn Corporation exchanged shares of its $2 per common stock for all of Mark Company's assets and liabilities in a planned merger. Immediately prior to the combination, Mark's assets and liabilities were as follows. So we are given Mark's company assets and liabilities and liquidities. So immediately prior to the combination, Flynn reported 250,000 additional paid-in capital and 1,350,000 retained earnings. So the fair value of Mark's assets and liabilities were equal to their book values on the date of combination, except that Mark's building worth $1,500,000 and equipment was worth $300,000. Costs associated with planning and completing the business combination totaled $38,000 and stock issue cost totaled $22,000. The market value of Flynn stock at date of combination was $4 per share. So we are asked to prepare the journal entries that will appear on Flynn's books to record the combination if Flynn issued 450,000 shares. So again and again, the first thing that we need to do is to calculate the goodwill. Okay, so before the calculate goodwill, we need to calculate the fair value of the net asset. Yeah. So again, total asset minus total liabilities. So for this question, we need to add one by one. Okay, for the cash, accounts receivable, inventory, land. Remember, buildings is worth 1,500,000. So we do not use this number. Okay, so we use 1,500,000. And then the same thing with equipment. We do not use this number. Instead, we use this number, 300,000. Okay, and then we minus off the liability, which is the accounts payable, short-term notes payable, and bonds payable. And then we minus it, we get 1,673,000 for the fair value of net asset. And then we calculate the goodwill, okay, which is total consideration minus the fair value of net asset. Okay, the total consideration is shares. Okay, so Flynn Corporation acquired Mark Company by using shares. So remember, the shares issued is 450,000 shares. The market value is $4. So that's why we use 4 times 450,000 shares minus the fair value of net asset. Okay, $1,673,000. So we get a goodwill, 127,000. For the next thing, before we do record the asset and liabilities, we record first the expense. Okay, so this is cost associated with planning and completing the business combination is called as acquisition expense. Okay, so debit acquisition expense, credit cash. Okay, and then the stock issue cost is 22,000. Yeah, so debit deferred stock issue cost, credit cash. And then the next thing is we record the asset and the liabilities at fair value. Remember, okay, so cash, accounts receivable, inventory, land, building, equipment, and remember goodwill. Okay, always remember goodwill. So the number is the same with the table, except that the building and the equipment, which is the fair value given in the question. Then the accounts payable, short-term notes payable, bonds payable. Then the common stock is $2 par. So $2 times 450,000 shares, we get 900,000. And then the additional paid-in capital, it is supposed to be 900,000 also, because the market value is $4. The par value is $2. So there's an excess of $2 times 450,000 shares, we get $900,000. Remember, we have deferred stock issue costs. Okay, so 900,000 minus 22,000, we will get $878,000.